Why choosing a mutual fund based on expense ratio is utter nonsense. This is what we are going to discuss today. Okay. Now, before going ahead, today's 5 points. Number 1, what is expense ratio? That's what we are going to discuss today. Number 2, why choosing a mutual fund based on its expense ratio is nonsense. Why influencers or even trainers ask people to look at it. Next is how actually is it calculated by the mutual fund. If you understand it, then you will know that it is really nonsense to look at expense ratio. Okay, so for that you'll have to wait till the end of the video. If not expense ratio, then what? Okay, these 5 points we are going to discuss today one by one. My name is Utpal KC. What is expense ratio? Before answering this question, I would like to ask you one question. Why do fund managers manage your money or fund? So you have got 4 options. A, fund manager loves me so much. B, a fund manager manages fund, not cows. C, managing fund is fund manager's religious duty. D, fund manager cannot stop themselves from managing fund. If you have got any other answer, please write in the comment. The correct answer is fund managers manage money because they get some fees, they get some commission, right? And whatever fees, commissions they get, they take from the fund they manage. So that is explained, that is expressed in terms of expense ratio. Understood? So now you might be thinking, okay, if expense ratio is something which is being deducted from the investments, my investments, then why we don't look at it? Why we should not look at it? Right? Don't worry. You are going to understand everything very fine. Now, before going ahead, please subscribe and comment in the comment box and write whatever topic that you want me to discuss. And I'll give you the authentic discussion because I worked in the industry. So I'll give you an authentic description, authentic discussion with proper calculations. So please write what are topics you want me to cover. Okay. So now going ahead. Why it is nonsense to choose fund based on expense ratio? That is the second question. If the fund manager is good, if the staff is good, definitely they will ask for higher salary, higher commission, right? Definitely their expenses will go high. Okay, so it is almost like you have gone there and you have gone to a tea house and you have taken a cup of tea. Oh, it smells so good, it tastes so good. Then you ask him, hey, how much profit they are making? Oh my God, they are making very good profit. Oh, is it? Are they making very good profit? If they are making very good profit, then I'll not take this cup of tea. Understood? Same is true with mutual funds. So if you are rejecting a mutual funds because their expense ratio is high, then it is utter nonsense. You need to look at their performance. You need to look at how beautiful this cup of tea is, how it smells. Are you getting the value? You should not be bothered how much profit they are making until and unless you are somebody who is going to own that particular company. So you must hire somebody who performs better. Understood? Because ultimately what matters is performance, right? So now, got it? Okay, if you've got it, understood it, write in the comment, understood, and give your comment also. Okay, that will encourage me to make more videos. Anyway, I'm a lazy guy. Okay. So now let me give you some examples here so you will understand it, and these are real life examples, but let me tell you, I collected these informations a couple of weeks back, so they might be a couple of weeks older. So this is one fund. I have taken it from valueresearchonline.com couple of weeks back. LIC Mutual Funds Infrastructure Direct expense ratio is 0.58%. Invesco India Infrastructure Direct expense ratio is 0.79%. Which one is better? Tell me, which one is better? Okay, as per all of financial influencer, okay, as per all those influencers and trainers, okay, there are some big trainers also. I have attended their sessions. They say, look at the expense ratio before buying the mutual fund, right? And it shocked me because I came from the industry. Okay, so now look at the 3 years return. The first one gave 25.3%, the second one gave 23.74%. Okay, I told you that this Invesco has higher expense ratio, that's why they are giving lesser return. Wait, ICICI Pru Infrastructure Direct, expense ratio 1.15%. Oh my God. 27.80% return. Understood? Again, Edelweiss Mid Cap Direct 0.39%, Motilal Oswal Mid Cap Direct 0.65%. 3 years return 22.77%, Edelweiss Mid Cap, charging less, giving you less. Motilal Oswal charging you high, 0.65%, giving you high, 29.08%. That means looking at it, you know it is absolute nonsense to choose a mutual fund based on expense ratio. There is no correlation. What matters for you? How much return you are getting, that matters. Not how much they are making. It is not matters. Yes, true. If they charge less, had they charged less, then you would have made more. But he is a good guy, man. He is a good fund manager. His team is good. His analysts are expensive. He will charge you more because he is giving you more return, probably. But ultimately, what we have understood, it is a nonsense to look at the expense ratio. It doesn't matter. We are bothered with how much return we are getting, right? We are getting more return. Of course, risk-adjusted return, that is another chapter, right? If you are getting better return, risk-adjusted return, we'll buy that. Why influencers or even trainers ask people to look at it? Our third question. This is simply because they don't know how it is calculated. Most of them, they are not from the industry. Not all of them. Some of them are like having a very fantastic background. But most of them, as I know, most of them are not from the industry. They have not ever done any calculations themselves. They just did Google. Now the problem is, when you do Google, so it will take you to some blogs where it is being written by somebody, right, who never worked in the industry. And then you go to ChatGPT will look at that only. ChatGPT doesn't create it, right? So it takes that raw material from the internet only. Then only the language it gives from its side. Don't get fooled by all this people and this Google, ChatGPT, etc. Okay, so this is the reason why influencers or even trainers ask people to look at it, because they themselves don't know what to look at. How we decide which mutual fund is best. So there are a lot of statistical analysis. Alpha, beta, Sortino ratio, standard deviation, R square, coefficient of determination. So these are very scientific terms. If you understand it, then you can choose the right mutual fund. It's not expense ratio and all this lot of nonsense stuff people advise. I have seen it. So please be careful, right? Okay. So next is, if you have liked this video, so please click like right now. Please do that. Please click like and subscribe it. Okay. You are going to get a lot of such kind of good videos. You will not miss it. And they are extremely important. And I'll do proper scientific analysis. Please like the video. Please like the video. Subscribe it. Write comment. Give me some good words. Okay? Right now, do that. Please do that. Please do that, okay? Yeah. Okay, so now how actually is it calculated by the mutual fund company? Okay, so now let me open one spreadsheet. So first of all, now say number of units in a particular mutual fund. I'm keeping it very simple. Say there is a 1 lakh unit. Okay, 1 lakh units, number of units 1 lakh, and the total assets under management. Okay, assets under management, say shares. So market value is okay, assets under management, and here I am writing and market value. Oh, sorry. Market value is say 20 lakhs. Then say there are some bonds. Bonds say 1 lakh. Okay, bonds say 1 lakh, and there are some cash. Cash is say again say another 1 lakh. And suppose there are some loans, etc., short-term loans. The fund managers and the mutual fund company took for some purposes. So say, and this will be minus say loan, short-term loan. Say another say 2 lakh. Okay, minus 2 lakhs. Okay. So now this is the assets. So total assets is sum. This is the total assets, right? So how much it is? Okay, 20 lakhs. Okay. So rupees 20 lakhs. Okay, market value, they are all in rupees. Okay. Rupees. Okay. So now this is the total assets, right? So now this is the total assets, and from this assets, so they will deduct that expense ratio. Say expense ratio is say 1.5%. Okay, 1.5% expense ratio, and there are say total number of trading days. So normally it is around 250 trading days. We have 365 days in a year, right? So out of that, around 215 days is the trading days, roughly, after deducting your Saturday, Sunday, and then all the holidays normally. Okay, so now how this expense ratio is calculated? Expense ratio is calculated on everyday basis. Okay, so this expense ratio 1.5% is per year. Okay, always remember, but it is calculated, it is deducted on daily basis. So that means daily expense ratio. Okay, so expense ratio, expenses, what is the expenses? Expenses is 2 lakhs rupees, that is the total assets under management, net assets, into 1.5% divided by 250. Okay, so how much? 120 rupees they will deduct today. Understood? So if you do not understand, you just roll it back, this video, and look at it again. So I am repeating again. So this is that 2 lakhs rupees total assets into 1.5% divided by 250, because it is deducted every day whenever trading happens. So now, so post expense total asset is, so net total assets. I am keeping it simple such that it becomes easier for you to understand, but this is how actually it is calculated. So 2 lakhs minus 120 rupees. So this is whatever it is. Okay, 19 lakhs, not 2 lakhs, 20 lakhs, right? 19 lakhs 99,888. Okay, so now what is the NAV, net asset value? Net asset value is this 19 lakhs 99,880 divided by total number of units, 1 lakh units. So net asset value is 19.9988 rupees. Okay, so again I am writing it RS because the symbol is not coming somehow. I will check my computer later. Okay, so now this is the NAV. Now you see one thing. if you want to buy this particular mutual fund, you'll have to buy at 19.9988 rupees per unit today. Understood? So that means when you buy that mutual funds, the expense ratio is already deducted. Now you have already decided I am going to buy this particular fund at 19.9988 where expense ratio is already deducted. Okay, again after that, if you take a decision, okay, let me look at the expense ratio, this is something utter nonsense. Okay, it is almost like what I said. You have taken a cup of tea and it smells so good, you love it, tastes so good, and then you ask, hey, how much they are making? Oh, this is a very good tea house, they make huge profit. Then you are becoming, oh my god, they are making huge profit, I am not going to have this cup of tea since they are making good profit. Take me to something who barely managing or they are making losses. Take me there, I will take such kind of tea only. The tea will be horrible, most probably. Understood? Okay. Now, suppose after 1 week, what happens? This 20 lakhs has become, say, 30 lakhs. This bond 1 lakh has become, say, 1 lakh 20,000. Say cash has become, say, 5,000. Loan has been reduced, it has become, say 8,000. Okay, so what will be the total assets now? The total assets has increased to 31 lakh 33,000. Expense ratio remains same, but since the total assets value has increased, right, this expense ratio will also increase. What happens? Earlier they deducted 120 rupees, now they will deduct 187.98 rupees. Understood? So this is the appreciation. Now what happens? What is the total? Net total asset? Net total asset is 31 lakhs 32,812 and NAV has increased to, oops, what happens? Okay, this 1 lakh I didn't give. Say same 1 lakh, the NAV has increased to 31.3281 rupees. Okay, so you are concerned with this, that 19 rupees from 19.99 it has increased to 31.32. This is your appreciation. Okay, whether you invest 500 rupees or 1 lakh rupees, this 31.3281 divided by this minus 1, how much? 56% appreciation, 56.65% appreciation. You should be concerned with this appreciation. If you do not know how to look at alpha, beta, Sortino, Sharp, etc., 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 if you do not know how to look at it, but you should know how to look at it if you really want to make money using mutual funds, and to choose the appropriate mutual fund, you must understand all these things. Got it? So this is why looking at expense ratio is utter nonsense, because you do not buy the mutual fund company, you buy a unit. You are concerned with, if I buy this unit, how much return I will make. If the mutual fund house is good, they might charge you more, definitely. Of course, there are other factors also, even if they are good. So based on the other factors, they might charge you less, because they also try their best such that they can give you more return. Because as you have seen, if they make more return, they could get more expenses. Okay, they can deduct more because it is based on this expense ratio. Do not show me, hey, legally this is not allowed, that is not allowed. Like, I know all these things. I am keeping it very simple such that you can understand, and you understand that looking at the expense ratio is utter nonsense. right? If not expense ratio, then what? Our last question. Oh, if not expense ratio, then what? If not expense ratio, then what? Yeah, I have already told you it is a performance, okay? But let me tell you, it is not just a return, it's called risk adjusted return. Okay, so now that is another chapter. So how to choose the risk adjusted return? So that is for understanding that you need to go into details. Okay, if you really want to understand it, okay, why you don't join my course? You can join my course. Okay, I'll give the post that link somewhere below, right? Please join my course so you'll understand the details. Okay, so you need to understand to choose the right mutual funds. You need to understand market valuations. You need to understand something called Shortino ratio, Sharpe ratio, standard deviation. There are so many things, so many statistical analysis are there, and they are there ready-made. Okay, probably I'll show you sometimes. Okay, and so based on that you need to choose, but this is a long chapter. It's a big chapter. It's a big subject called portfolio management, equity research and portfolio management. Okay, so now I'm going to show you in the next video why chasing return is a big trap. Okay, right? If you are thinking that whatever mutual funds gives highest return, you should buy that, that is a big trap. I am going to make a video. Please tell me all the topics that you want me to cover in the comment box. Okay, I wish you all the best. Do not invest in anything without proper understanding. See you.